The Naira closed at 493 Naira to the dollar at the parallel market. This comes after the Central Bank of Nigeria said it's running a managed float regime and benchmarked all FX transactions against the NAFEX rate. Tunde Adama, the head of trading at CITI Nigeria, joins us now for a focus on Nigeria's local currency markets. Tunde, thank you so much for your time today. So let's unpack the significance of that move, the shift to the NAFEX rate by the central bank. Does it change anything significant for you?
Well, I think for operators, no, because the truth is that more than 90-something% of transactions already happen at the FX rate. A lot of the central bank interventions to investables, SMEs, everything already happening around that rate. So I think it was just the central bank acknowledging that it has already moved most of the things to the FX rate, and also listening to the earnings of most operators who have said, look, let's unify our rates and just have one single rate. But for most operators, for most people in the market, this doesn't really change that much. So I think it's affecting the parallel market. It's probably more of expectations. People who probably feel that this move is a big devaluation, and that if that happens in the official market, then we should see a significant move in the parallel market as well. But in reality, for people who have been using the official market, it doesn't really change much.
So what I think I hear you saying is that shift that we're seeing in the parallel market rate will be short-lived, and perhaps in a week or so we should be moving closer to the rate, which was I think somewhere around 480 Naira and change before this announcement about the NAFEX rate being adopted by the central bank.
Yeah, I think if no other policy change happens or major change in demand supply dynamics in the market happens, I think after the initial expectation of further deflation, once people see that nothing has changed, I do expect that we'll go back on that 490. Just because if this move is just based on the announcement of NAFEX as the new official rate, in terms of how it really affects most operators, it's not much happening. So yeah, I won't be surprised if you go on that 490.
No doubt it's been quite challenging for the central bank to manage the currency markets over the last year or so. Obviously, we all remember the lockdowns in March last year and the impact of close to $0 oil on the foreign exchange markets. But do you get the sense that there is any significant shift in terms of supply, first of all, to the local Forex markets? Now that we are 1 year past the worst of it, do you get the sense that things are moving in the right direction now?
Well, the central bank, to be fair to them, have, if you look at what they were supplying in the middle of the lockdown and what they are supplying now, they are selling quite a lot more than they were. I guess when the borders were closed, right, it didn't make that much sense to sell as much if people weren't able to do so. But they've started selling. They're selling to SMEs. From about January, they started selling more to SMEs, selling for people who wanted to buy retail amounts, school fees, medical, travel allowance, and all the invisible segment. And they started selling more to corporates and investors as well. So the central bank has increased the amount they are selling. I think the challenge is that we haven't seen return to the country from investors as well, who typically are also a major supplier of FX to the country. And I think a lot of the moves central bank is doing now, including adopting NAFEX, unifying the rates and all, is probably part of the steps they're taking to try and convince investors to also start coming back. So the central bank doesn't remain almost like the sole supplier of FX, or the main supplier of FX to the market, and the other big suppliers will also return to the country.
No, certainly that's a very important point, and many have applauded the move by the central bank to do its best to unify those rates, and we'll see how this move works out as we observe the markets in the next week or so. But I want to come back to your thoughts on the foreign portfolio investors. What more would they like to see? Now, clearly, unified rates is something I'm sure many would like, but then would that be sufficient? Let me start with your thoughts on where interest rates are at right now. They've certainly moved up quite a bit from where they were November last year. Do you think that move is sufficient to lure foreign investors?
Well, like I said, we have seen a huge move on interest rates. We're back to at least double digits across the 1 year. And if you are investing in bonds, the long end, you're able to invest about 14%. Investors are a very tricky bunch, right? Because they've been out on the sidelines for a while. You might find that they expect slightly higher yield. But like I always say, what it takes is the first set of people to come back in, invest in Nigeria. And you find that some of the higher yields that they're asking for, they will be willing to come in a bit lower. I think the currency is also an issue. Most of the time, they want currency that, especially after there's been some sort of dislocation like this, they want the yields, they want the currency at a much higher level than it is now. And I guess that might be one of the concerns that they have. But again, as oil prices get higher, as we start to see, I mean, the FGN went to the National Assembly to ask for permission to raise some debt from offshore. If we get some of that coming back in and the reserves go up, you might find that the rate at which they are willing to come in is better than what they're expecting now. So I think the central bank has done a lot in terms of exchange rate and interest rate, but the investors might still be waiting for something slightly higher. I guess in the end, they will meet somewhere in the middle. So it's just to see what they're expecting and see how soon the central bank is able to convince them to come back into